In New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, while President Donald Trump says China wants to make a deal on trade, the U.S. and France actually strike a deal to end a feud over a planned French tax on some tech giants. Plus, trade is front and center for Apple investors. The company sheds billions of dollars in market value as the spotlight shines on its massive Chinese production base, from which almost all of the world's iPhones are made. And iPhone parts are playing a role in a lawsuit. GlobalFoundries sues larger rival Taiwan Semiconductor for using its patented chip technology and requests a U.S. trade agency impose import bans that could roil the electronics market. But first, to our top story. Now, days after escalating the trade war with China, U.S. President Donald Trump is saying Beijing badly wants to make a trade deal.
So when you say, do you think they want to? Maybe they want to and maybe they don't. But I think they want to make a deal. I'm not sure they have a choice. And I don't say that as a threat. I don't think they have a choice. In the meantime, the United States, which has never collected 10 cents from China, will in a fairly short period of time be over $100 billion in tariffs. So I think they want to make a deal very badly.
To discuss more about all of the trade news that came out from the G7 meeting in France, I want to bring in Bloomberg's Peter Coy. Peter, it's very interesting. We sat here Friday in the market, the stocks, the chip makers off more than 4%. Yeah. Today, at least the market seems to think that the trade tension sentiment has improved. Would you agree with investors that we got sort of an improved reading today on trade, or is the market maybe a little bit off today?
Well, it's mildly better. The very fact that Trump is talking, as we just saw, about saying the Chinese very badly want a deal, to me, I read that as Trump wants a deal, and he's sort of projecting it onto the Chinese. He's making, you could regard that as Trump's way of saying, let's work something out here. He's not, he still wants to do it on his terms, but he's talking about negotiating rather than raising tariffs again.
Peter, if anyone talks about U.S. trade deficit, it is you. If you come into my terminal here at GTV Go, we've talked a lot about how the deficit has narrowed recently, but long term, this trend of U.S. trade deficit between the U.S. and China is getting bigger. So does Trump really think that Beijing needs this deal more, or do you think that the U.S. needs this deal more?
I think China, still being a smaller economy than the U.S., much more export dependent than the U.S., and being a poorer country, of course, does need a deal more than the U.S. does. But that doesn't mean that President Xi of China will give in to whatever Trump wants. He has to save face, for one thing, internally, and which is extremely important to him. Plus, he doesn't face an election the way Trump does, so he has the ability to face this thing down more than Trump does. Trump has an election coming up next year. He can't very well put the U.S. public through incredible pain with the hope that something better will happen later, because he'll be out of office by then.
Any other final words on big news that came out of trade today?
Well, we had the G7 meeting, of course, in Biarritz, France, and we had Emmanuel Macron, the president of France, drafting up a statement. It was not quite an official communique, but expressing the view of the group of seven, that we should still keep pursuing open, fair trade. So I think that's the tone that we're seeing from the markets today.
Well, we will keep pursuing that conversation with you in the days to come, I'm sure. Thank you. That was Bloomberg's Peter Coy. And it's nearly impossible to talk about all of the effects of the trade war that it's having on the tech industry without, of course, mentioning Apple. Now, the iPhone maker has shed tens of billions in market value since President Trump escalated tariffs on Friday. That includes his tweet that, quote, he's ordering U.S. companies to move out of China, something that Apple analyst Dan Ives says is wishful thinking.
It's a nightmare that doesn't go away for the street. And ultimately, we continue to handhold investors through this and try to quantify the risk. But ultimately, it comes down to this. It's an impossibility for Apple to move more than 5 to 7% of production in the next 18 months. If they move 20%, that would take 3 years at a minimum.
So to discuss this in Los Angeles, a Bloomberg tech reporter, Mark Gurman, he covers Apple for us. And on the phone, D.A. Davidson, senior research analyst Tom Forti. He currently has a buy recommendation for Apple. So, Mark, let me start with you quickly here. You know, Dan Ives has said that China can really only move about 5 to 7% of that production out of China. Even then, it could take 18 months. What's your take, again, as we sort of confront these trade tariffs on China's or Apple's really ability to work and move around China?
Right. From everything that I know and that I've seen evidence-wise, I agree with Dan that it is going to be an extensive process. It is going to take a long time. And if you take a look at why we're in this position, it's because of the U.S. and China trade war. It's because of the current political landscape. And if you think about it, it could actually take longer than it would take to reach another, president, different leadership past, if Trump wins again, past the next 4 or 5 years or so, for him to even relocate everything. So there's a question to be asked, is it worth Apple waiting it out? It's really unclear what an administration after Trump would do tariffs-wise. And also another question to ask yourself is it more expensive to move everything? Would it be more expensive to move everything from China than the cost of tariffs in the first place? So there are a few balancing acts that are going on here for Apple.
Tom, it's great to have you here, especially on a day in which you write a note that says the headline is, "We would take advantage of tariff sell-off to buy these stocks," the first of which listed in your note is Apple. So walk me through how pressured you think Apple could be from the tariffs and their supply chain in and around China.
Sure. So actually, in the note, what I was trying to point out is that in some regards, we're looking at Apple in the wrong way, meaning that this is a company of such great size and such political influence in both the U.S. and China that the rules really don't apply for Apple. And you saw this earlier this year when they got exclusion from the U.S. tariffs for their Apple smartwatch, among other products. And you saw it more recently when there was a delay in the initiation of a tariff that basically gives them one more chance to sell next-generation iPhones without tariffs. And then on the side in China, we would argue that with 20% of their sales to Chinese consumers, and given this large supply chain effort that we're talking about in China, Apple may also be able to negotiate favorable terms, at least relative to the other consumer technology companies within China. So yes, we still think this is the biggest risk to the company, but we think that generally speaking, investors may be overestimating how much it could hurt Apple when, again, they're able to negotiate with both the government of China and the government of the U.S. because of their influence.
Tom, assuming that tariffs go in place and Apple is faced with the decision of passing on higher costs onto the consumer, how healthy is the consumer from your perspective to absorb an iPhone that costs now at least $1,000 or more? Is that something that Apple is willing to do and can do, frankly, at this point?
So from my vantage point, I think that what we've seen with the current generation iPhone devices is Apple doesn't have the pricing power we once thought it had. And I would argue looking forward, it will have pricing power when it comes out with a 5G device, especially one that can be used on a global basis versus just those markets that have 5G technology today. So I would argue that, yes, Apple has pricing power because of its brand, but I think it may not have pricing power on the smartphones until it has a global 5G rollout.
Mark, let me bring you back in here. As we were thinking about Tim Cook's meetings with the president and the White House overall this week, a lot of the concerns stem from Apple losing market share, namely to Samsung, which is now #2 in the U.S. How concerned is Apple mostly now about losing market share to some other competitors?
Yeah, and I think that brings us back to the price question, where I think that the pricing, because of these tariffs, have already been priced in, not only to the stock in some regard, but also into the products themselves. I mean, Apple had to anticipate this coming with this current administration. It's been talked about for years now under Trump. And you saw price increases to the iPad Pro, $150 in October, the iPhone by about $300 at the end of 2017, the Apple Watch, the AirPods earlier this year, some of the other iPads earlier this year. So I think that in terms of losing market share, those concerns would have already come into place because I don't think the tariffs are going to put any extra pressure on them there. The question is in terms of margin, right? Are they going to take a bigger than expected margin hit? And that could mean that their products, just become even more unaffordable than they are already. And that could give Samsung some headway.
Tom, is market share or margins more of a risk for Apple? Would you sacrifice margins for the sake of protecting that market share?
So I would say market share. But I think, again, the other thing we're not necessarily thinking of for Apple is a lot of their new initiatives are less affected by tariffs. If you think of their proprietary video content, everything they're doing in financial services, including payments, the new Apple Card, and then their efforts in healthcare. So the good news for Apple is, again, influence to both governments in U.S. and China, and a lot of their growth initiatives less affected by tariffs, proprietary content, financial services, healthcare, et cetera.
All about that diversification. Thank you. That was Tom Forte of D.A. Davidson and Bloomberg's Mark Gurman. Thank you both. And coming up, a lot of eyes are on WeWork as it gets ready to go public. We take stock in what its bonds have to offer. That's next. And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Now, we always talk about how trade is affecting the equity price of all these tech stocks. And if it's true that smart money's in bonds, well, I wanted to see how trade and tariffs were affecting the price of debt from these big tech companies. And more importantly, if trade is impacting, of course, the amount of debt that they are issuing. To discuss all of this, I want to bring in Bloomberg's corporate bonds reporter, Molly Smith, and in Chicago, Jordan Chalfin, senior technology analyst for Credit Sites. Molly, let me just start with you. Generally speaking, we know that equities are so volatile given any tweet, any headline. How are the bond prices of these big tech companies doing?
It's a lot more resilient when we look at the fixed income side of things. And I often point to Apple's earnings even as a great example of this, that everyone's looking at number of iPhones sold, right? And if let's say the estimates are calling for 90 million sold in the quarter, Apple only sells 70 million, stock sells off rampantly. This is already not looking good for signs of growth, either in the company or in the share price. Bond prices will not move on something like that. Apple still has cash. They're still going to pay you back, not going to default on the debt. And so far, it's been pretty much the same story in the bonds.
Jordan, let me bring you in here. Would you say that these bond investors are a little bit less nervous about trade, so to speak? Is it easier for you to sort of focus as a debt analyst on some of the fundamentals, cash flow, cash, reserve levels, all of that, and sort of ignore the headlines, so to speak?
Yeah. For the most part, I would agree with that. I think that certain credits are a little bit more exposed to trade, the direct impact on tariffs. Apple would be a good example, but obviously has a really good balance sheet to support that. So I think in the past cycles, tech has been it's a really highly rated sector, so it's considered very defensive, but it has underperformed a little bit. Given that the trade war is what's causing the pressure right now.
Well, Jordan, you had a great chart in your note talking about the issuance levels, and I wonder how much of these headlines have sort of stopped companies from issuing debt if they're nervous about their future growth opportunities, or frankly, coming to market because debt has never been cheaper than it's been in 3 years and arguably ever.
Yeah, no, absolutely. That's a good point. I mean, tech issuance really exploded over the past 10 plus years given synthetic repatriation. With over $150 billion of debt being issued in 2017, that really fell off a cliff in 2018 following tax reform, and that resulted in really strong technicals in the space. Now, in 2019, the year-to-date issuance is actually up over 2 times 2018 total level. That's really a combination of M&A and refinancing activity.
And Molly, you also noted that repatriation folds into this story as well, because that was part of the law that was, I guess, now 2 years ago or so. How has that affected some of these tech companies, given the cash overseas that they can bring back to the U.S.?
Well, as Jordan was saying, tech used to make up a much bigger part of the investment grade universe than it does today. I mean, we've seen, of the 50 billion or so tech issuance this year, half of it was really done all in one shot from IBM. But in the past, we've seen repeat issuance from Apple several times, to fund share repurchases, et cetera, and from other companies too. And that hasn't really been the case since the repatriation laws took effect. You now have access to all of this cash overseas that you didn't have before. So no need to really go out to the debt markets to finance these buybacks if you already have this cash on your books.
Jordan, I don't know if you can see this. I'm pulling up a terminal here on our chart for our TV and our radio listeners here, and it's looking at basically the option adjusted, option removed spread, what you call it, between Apple and Qualcomm. And Molly has noted out that more and more of these sort of lower quality issues are making up more of this broader index, yet the spreads between Apple and Qualcomm are frankly sort of holding right in there. You're not seeing a big expansion or a big contraction. What's your take when it comes to some of the debt levels on companies you cover, like an Apple, like a Qualcomm?
Yeah, sure. I think, for 10 years in, a company like Apple is going to be really strong for its balance sheet strength. I think when you start looking at the 30-year bonds, there's a lot better places to take risk. Actually, our semi-analyst, Andy Lee, upgraded Qualcomm this morning, given the partial stay ruling on Friday, which basically lets the company operate, maintain the status quo for the time being. And the company has really, really strong market share positions, baseband, modems and application processing and RF front end. So, I'd advise clients to take a little bit of risk. You don't need to be an Apple, but certainly take some caution for the low triple B names. Going back to the trade war risk, you kind of want to proceed with caution. Stay away from those highly levered names, because it's really the indirect impact of the trade war that creditors need to pay attention to if it causes a downturn.
Well, Molly, Jordan was talking about sort of taking on a credit risk, when you can, of course. And if you guys come back into my terminal here at GTV Go, we're basically looking at tech spreads in the high yield market versus the overall Bloomberg high yield market in general in blue. Tech high yield spreads are much lower. Yields are much lower, I should say, than the broader high yield market. Given all the headline risk, I frankly just have to ask why.
Yeah, we've actually seen, it seems like a bit of the opposite story in high yield versus investment grade tech, whereas in IG we've seen a lot more of the lower quality names start to make up more of the index. In high yield, it's that the index is actually moving up in quality. So we've seen a lot more companies getting upgraded, even some rising stars like First Data being one of them, got acquired by an investment grade company in Fiserv. So that's definitely a positive technical as well when you have some upwards rating momentum.
Well, wonderful. That was certainly a segment that I love. Next time both of you are coming back on, we'll debate some single named stories as well. That was Jordan Chalfin of Credit Sites and Bloomberg's Molly Smith. Thank you both for joining me. And coming up, Tesla's solar panels are caught in controversy. Amazon and Walmart are blaming the company's solar business for several warehouse fires. We'll discuss how all three companies are responding next. This is Bloomberg. Now, Amazon has joined Walmart in blaming Tesla's solar panels for fires. On Friday, the e-commerce giant said a fire on the roof of one of its California warehouses involved a solar system installed by Tesla's Solar City division. Now, this is just days after Walmart had sued the company, saying its panels caused fires at more than half a dozen stores. Amazon said it has no plans to install more Tesla systems. Joining us from Seattle to discuss this is Bloomberg's Matt Day. Matt, basically waking up to this story after hearing the Walmart story last week is pretty interesting. What do we know so far about how this all happened?
So what we know is that a fire that happened last summer in one of Amazon's warehouses east of Los Angeles. They got a bunch of warehouse space out there. There was a rooftop solar panel fire that was reported at the time that it turns out was a system installed by Tesla Solar City. And what this means, I think, for Tesla is that this very prominent, very loud lawsuit with a big corporate name in Walmart is not an isolated incident. If Amazon is saying there's also some fire damage that they had as well.
Yeah, what are Amazon and Walmart saying? I mean, we've heard that they are saying we're no longer going to install new solar panels. We know that there's been a lawsuit. Does Amazon intend to sue, or are they still sort of just now coming out with this news?
Yeah, they're just coming out with this news. We had asked them about it last week, and that was the source of the story on Friday, that they did have a Solar City fire. There's no indication that Amazon's planning to take Tesla to court as Walmart did, but they were pretty definitive in saying that we have no plans to install a Tesla solar system in the future. And that's potentially a big blow for Tesla. Amazon's among the more aggressive installers of corporate bought solar power in the United States. They were #1, I think, in installations in 2018. And so kind of turning off the tap there as a potential source of demand for Tesla solar panels could be something going forward.
Well, and Mark, to be fair, I mean, you've really focused on Amazon and do a wonderful job. For our purposes, I wanted to bring out some of Tesla's comments as well and their statement, just to be fair here. And they're really saying that all 11 Amazon sites with solar from Tesla are generating energy. They're proactively monitored. They're maintained. Tesla has worked collaboratively with Amazon to sort of find out the root cause of this system. And again, we continue to sort of proactively monitor the system. So at least for Tesla's perspective, they're certainly trying to come out and create more of a cordial tone. Any idea, knowing that you don't cover Tesla, sort of what this means for them and Solar City? I mean, if you have two big companies coming out and saying we no longer want to install new solar panels, any idea how big of a hit this could be for them?
I mean, it's more bad news after bad. I mean, the solar division was already struggling with deliveries of the last few years. Just another warning sign for them, I suppose. And I think we should also note, to their credit and to their point, Amazon didn't say they were stripping things off of their warehouses or data centers, solar installations, that is. So, to Tesla's point, as far as we know, plenty of other facilities are operating without a hitch right now.
Right. Wonderful. Thank you. Well put. That was Matt Day joining me from Seattle. There you are, from Seattle. Thank you, thank you. And meanwhile, enjoy discussing politics at work? I don't know if I do. Don't take a job at Google either. So new internal rules represent a shift away from the internet giant's famously open culture. They discourage employees from debating politics and having other disruptive conversations. Google warns workers they'll be held responsible for what they say at the office. And chip supply chain challenge. We look at two companies in a heated legal dispute over technology that could potentially hit billions of dollars in deals. We'll have the latest. There it is, between GlobalFoundries, Taiwan Semiconductors, and then we had, of course, Qualcomm coming up, trying to settle that suit as well last week. This is Bloomberg. I'm Taylor Riggs. This is Bloomberg Technology. Now, U.S. chip maker GlobalFoundries is suing its larger rival, Taiwan Semiconductor, for patent infringement. The Silicon Valley company accuses Taiwan Semi of using their technology to help win billions of dollars in sales. The case has the potential to disrupt the supply of everything from smartphones to PCs. Joining me to discuss this is Bloomberg Technology's Ian King in San Francisco, and on the phone, Stacey Rasgon Bernstein, senior U.S. semiconductor analyst. Ian, let me just start with you, sort of line up what we know from the case so far. Loved reading your story on it. Sort of as global foundries sort of taking on Taiwan Semiconductors. What do you make of this?
Yeah, I mean, this is potentially a huge deal. I mean, there's lots of patent cases around the world all the time. We don't really pay a huge amount of attention to them, but this one is pretty far-reaching and pretty aggressive, and the venues that they've chosen have some real teeth. You know, in theory, what GlobalFoundries is asking for could have a massive effect on the global supply chain. TSMC is absolutely essential to any number of products, obviously most notably Apple, and what GlobalFoundries is going after here is an export ban, which could, in theory, mean that Apple wouldn't be able to bring a lot of the products that it has made elsewhere in the world into the United States.
Stacey, I want to bring you in here, not necessarily to talk specifics of the GlobalFoundries and Taiwan Semiconductor case, but more broadly speaking, to me at least, it seems like we're hearing more and more of these patent infringement cases that are sort of coming out now. And I wonder, is it new, or do these chip makers feel a sense of urgency and competition and threat that they're being perhaps more aggressive in protecting their technology, protecting their market share?
That may be. I mean, the idea of IP protection is not new in the industry, and we've seen these types of suits pop up all the time, like historically. But I would say that the magnitude of some of the suits does seem to have gotten larger. Again, we have the one today. Obviously, you mentioned Qualcomm. You may have mentioned Qualcomm earlier. We just had a massive IP case kind of go through, attacking multiple parts of their supply chain as well. So it does feel like, I think as the industry has gotten mature, as we've gotten more consolidation, and certainly as sort of broader uncertainty has sort of been peppering its way across the supply chain through a number of other exogenous factors that are hitting, I think IP is becoming more important. And it does feel like these things are getting bigger.
Well, and Stacey, one company that you know of that is sort of perhaps breathing a small sigh of relief is one of Qualcomm. And we got the news last week, of course, that a federal appeals court had said that the company will not have to renegotiate its patent licenses while it's in the midst of sort of appealing all of these antitrust rulings that are going on. How much of a win was that for Qualcomm?
It was a win, and it wasn't. So, I mean, look, the appeal process itself is going to take some time. I think the case was put on the docket for January of 2020. It may even take longer than that. And so obviously Qualcomm, they don't want to have to renegotiate the licenses at all. But certainly they don't want to renegotiate them in the wake of that appeal, because their belief is if they win, then the horse will be out of the barn already. So I think it was a win for them in that sense. Now, you also have to step back, though. Number one, investors, I think, were already expecting them to get the stay. So, I mean, actually, Qualcomm stock was down in line with everything else on Friday, even in the wake of that news. I also think even if they were to prevail full stop on the appeal, you're still left with the status quo. And the current status quo of their business doesn't look so super. Their licensing business appears in structural decline. Even if you take out the impacts of the recent Apple settlement, they're still working on Huawei. Even if you take that out, their licensing business appears in decline. And the chipset market, that's actually driving more of their revenue now, and they seem to be shifting the story over to that piece of their business. The chipset environment looks horrendous right now, just given some of the stuff that's going on with tariffs and trade and Huawei and everything else. And just in general, the smartphone market's weak, so that's not really helping them either. So the status quo, even if everything is fine on these legal cases, they're still stuck with that. It doesn't look super.
Ian, come back in here. Given the news about GlobalFoundries today, the Qualcomm news last week, what are the implications for the global supply chain from the companies that you speak to?
Yeah, I mean, everybody is right now, and in fact, GlobalFoundries mentioned it in some of their press release regarding this case. Everybody is heavily focused on what's happening with China and the supply chain and the US-China trade war. That really is a massive cloud on the horizon for everybody. As long as this situation persists, people are concerned that China is going to find a way to live without the US as quickly as it can. Arguably, it was trying to do so anyway, but now they've got an absolute incentive. That's the overriding concern that I think is in everybody's minds right now.
Stacey, what is your take on the global supply chains? How much are you able, or can you factor in all of the uncertainty around patent infringement cases and lawsuits into your analysis on how you can value a company?
Yeah, this is the hard part. So, I mean, the direct impact of this stuff you can size, and it's relatively minimal. So, for example, on tariffs, which is a cause of this uncertainty, the direct trade in raw semiconductors between China and the U.S. is very small. It's less than $9 billion a year. And in the context of an industry that's close to $500 billion, I mean, it's a drop in the bucket, so that doesn't matter. Same thing with the Huawei exposure, that's been, we've seen, bans and everything there. And Huawei for the entire industry overall is low single digits. It's not fun, but it's manageable. The worry is the indirect impact. Most semiconductors travel between China and the U.S. inside of other things that is getting potentially impacted by tariffs. Tariffs raise prices, that drives potential demand destruction. You can get currency movements. Obviously, you have the broader impacts on the macro environment. And the problem is the potential outcomes range anywhere from no big deal to doomsday. And it's really difficult to judge where on that spectrum we're going to end up. So it just drives a lot of uncertainty. And what we're seeing now in the supply chain is people are unwilling to make decisions. So companies are, they're not sticking their neck out. They're buying what they need for that moment in time, and they're very hesitant to do anything else beyond that, to do anything longer term, because they just don't know which way the winds are blowing right now.
Ian, let me just quickly give you the final word here. What's next? What should we be watching for, whether it's a new case that could be hitting the news or a settlement perhaps that some of these chip makers want to be able to move some of the headline risk behind them? What's the key thing that you're looking for next?
Yeah, in this particular case, GlobalFoundries is following a well-established path. What they're trying to do is put pressure on TSMC's customers, scare them, so in turn that they will then turn to their supplier TSMC and say, look, you better sort this out, you better settle this, put this behind you, get a license, pay for this technology, then we can all continue to do business. That's always the aim in this particular case. If TSMC decides to fight this, then we'll see. Then it really is in the hands of the courts.
Well, great conversation. Thank you to both Bernstein senior analyst Stacey Rasgon on the phone and Bloomberg Technologies Ian King. And watch out, Uber and Lyft. The Berlin-based chauffeur service Blacklane is expanding its footprint in the United States. The company recently announced plans to open 2 U.S. offices this fall in New York and L.A. Bloomberg's Caroline Hyde caught up with Jens Waltorf, CEO and co-founder of Blacklane, to discuss the company's expansion plans and its road to the public markets.
We have started to expand into the United States quite early. Already in 2013, we launched our first markets, the usual suspects, the New Yorks and Chicagos, LAs of this world. And since those days, we were constantly growing our presence. Nowadays, we are serving roughly 80 cities in North America. And then it's no surprise, actually, that North America is our largest market. The US is our strongest country that we have. A third of our revenue is coming from US customers in the world, but also every third ride is happening in the US.
Talk to us about how you make your offering distinct. It's more of a luxurious experience than perhaps Uber or Lyft provide. But Uber also has a luxurious part of its service too. So how do you make yourself distinct as an airport ride and particularly serving the business community?
It's indeed a service made for the business traveler, frequent traveler into the world wherever they go. We want to be present and available at their fingertips. It's all about quality at the end of the day. We are making sure that we are in control of every little detail of the customer journey and dealing a lot with things like duty of care, making sure every ride is safe and our customers are protected. It's about the comfort that they are experiencing. Also, we are focusing on longer distances, right? So our customers are sitting approximately 1 hour on average in the car, and this is when you really are enjoying quality over any quick ride or other modes of transportation.
What about the business model in terms of sheer profitability of Blacklane? We've just seen that Uber, Lyft, they're struggling to reconfirm to the market that they have a pathway to profit. They seem to be loss-making businesses inherently trying to gain market share. How are you dealing with the very nature of your business and supporting it from a revenue and profit perspective?
I'm actually very, very happy and proud to have built a very profitable business. We have very healthy unit economics. Actually, we are having the opposite of the trend that we can see in the ride-hailing industry. So our costs are growing significantly slower than our revenues are doing. And I think this is the only way you can build a healthy business out there. To give you an idea, the bottom line unit economics idea, Blacklane needs one ride to generate the same bottom line contribution margin than a ride hailer would be able to deliver with 200 rides of their services.
Will you be looking to sell shares to try and educate the investor as to how you are similar and how you are different from the likes of ride-hailing businesses that have recently gone public?
So we are still investing more in our products and in innovation than what we would earn from our bottom line impact. So we are not yet fully profitable, but very much under control. So we are still looking for investments, as well as we are preparing for a potential IPO a few years down the road. We are currently thinking of 2 or 3 years in the future. But on the educational side, I think like it was kind of a blessing for us that we could see the recent IPOs happening, because now it's so much easier to educate our potential shareholders what the differences are between those two businesses, and they couldn't be further away, if you ask me.
That was the CEO and co-founder of Blacklane. And coming up, au revoir. That's what Trump and Macron said to France's digital tax. We'll dig into why U.S. companies agree with Macron that it was indeed a very good agreement. That's next. This is Bloomberg. Tech giants like Google and Facebook can breathe a sigh of relief. On Monday, U.S. President Donald Trump and French President Emmanuel Macron announced that they struck a deal to end a feud over France's digital tax.
And the date of international tax exists. On digital services, France will do away with its national tax system, and everything that has already been paid under the French tax system will be reinvested.
To tell me more, it's Bloomberg's corporate tax reporter, Laura Davison, and she joins us from Washington. Laura, sort of give me the breakdown of what was this tax and what deal did we get today?
Yeah, so earlier this summer, France passed this digital tax that would hit Google, Amazon, Facebook, this 3% levy on revenues in France. And the U.S. said, look, this isn't fair. U.S. tech company says you are specifically going after American companies. There were other tech companies that were affected, but it was mostly American companies. The U.S. trade representative opened up an investigation into this. Trump has threatened to put tariffs on French wine in response. And today at the G7, we saw them come to an agreement. Basically, what France agreed to is they said that they were going to negotiate these global negotiations that are going on. There are 130 companies that are, countries who are looking at basically reallocating taxing rights, basically which country has the right to tax which profits. France says, look, we'll join these negotiations, and when there is a global deal reached, they're hoping to reach something by the end of 2020, they will take away their tax and basically reimburse all the companies who have paid it. So they haven't agreed right now to repeal the tax entirely, but they've basically have an agreement in principle to, at a future date, repeal the tax.
What companies benefit the most? I know, of course, in the U.S. we talk about the big ones, a Google, a Facebook, but there's also a lot of Chinese, other international companies as well. Who are the big ones that are really benefiting from this today?
Yeah, it's the one you mentioned. It's Google, it's Facebook, it's Amazon. Also smaller companies too that are operating over there. But the thing that really we'll be looking for going forward is this global agreement that they're working on affects digital companies. So digital companies will be taxed, but it also affects pharma and manufacturing. And there will sort of be there's kind of been a global trend of that multinational corporations there's a consensus that for too long they've been able to operate in tax havens. Now countries are sort of banding together, wising up and saying, look, we're going to make sure that these corporate profits are taxed somewhere in the world.
I wonder, Laura, sort of, how much of a surprise this was. I mean, we knew that the digital tax had gone into effect. We weren't quite sure, maybe there was a ton of lobbying, but would it come out of the G7? Would it not? How much of a surprise was the news today?
It was a little bit of a surprise. Last week, tensions had kind of ramped up to an all-time high. Trump several times talked about the tariffs on French wine. There was a hearing in Washington where you had a bunch of representatives from all these tech companies coming in and talking about this. And Trump was saying, look, I'm going to do something on this soon. So there was an expectation that he might announce tariffs or some other retaliatory action. And today we definitely saw sort of things cool off a little bit. Kind of the lower level folks are going to negotiate. And there's a lot of optimism that France's tax will be fully repealed, though you do have Democrats in Congress saying, look, Trump should not agree to something that doesn't fully get rid of the French tax now. They need to repeal this now and not, basically start taxing companies and then reimburse them later.
And Laura, I mean, we should note that we did get, like you said, sort of an agreement between the U.S. and France, but Macron was coming out at the G7 and really talking a lot about wanting some international rules around this as well, and that he really would like some international clarity on this. Any idea what that would look like?
Yeah, so basically what they're doing, and it's basically, most countries in the world are looking at this, and it's basically they're kind of getting all together and figuring out at what point can which country tax which profits when you have companies that are operating across borders, and particularly in a digital economy where it's not clear that, oh yes, this profit was earned in this in this country at this factory, and you have users across the country, across the world who are using these platforms and these products. So they're really hoping to come to that agreement by the end of next year, and that should really create some clarity. And so really it's now down to, are companies going to be happy with this? Are they going to feel that they're overtaxed or that they got a good deal in this?
Yeah, well, perhaps maybe some much needed good news for some of the big tech companies that have otherwise gone a little beaten down in the recent months. Thank you. That was Bloomberg's Laura Davison. And still ahead, Lyft has received its third upgrade this month, why analysts are optimistic about the ride-hailing company's profitability. This is Bloomberg. Lyft shares rose on Monday after Guggenheim predicted that the ride-hailing company may turn a profit sooner than expected. The firm upgraded Lyft to a buy from neutral, setting a price target of $60. In a new note, analyst Jake Fuller said he expects Lyft to be EBITDA positive by 2021. That's ahead of his previous 2023 prediction. He said, quote, "We've all underestimated how quickly the competitive mindset might shift under new public ownership and how much leverage there is in the model to pricing." Joining us on the phone to discuss is Tigris Financial Partners Chief Investment Officer Ivan Feinseth. You also have a buy rating on Lyft. So Ivan, sort of walk me through if you agree or not with Guggenheim sort of bringing up the target to EBITDA positive profitability now at 2021 instead of 2023. What do your models suggest?
Yes, I do. I think that the growth rate of revenue, and there are a number of great marketing initiatives that they have undergone, could make the company a lot more profitable a lot sooner than people think.
What are some of the other main drivers that you see that's behind your buy call?
Sorry, you broke up there. We don't have a good connection.
What are some of the other main drivers that you have? You have a buy on the stock. What are some of the key positives that you see about Lyft?
The biggest opportunity is the overall gaining of market share in the transportation market. There's about $1.2 billion spent per year in ground transportation, and transportation as a service of what Lyft provides is going to increase as a percentage of that total spend. Also, Lyft is addressing a tremendous opportunity in healthcare transportation services for people who could not get to a doctor on their own, and in many cases, medical insurance or the doctor's office pays for you to get a ride from Lyft to come to the doctor or to the hospital for treatment.
Well,
non-emergency treatment.
Right. Well, I really like that you brought that up because indeed we do know that Lyft now provides Medicaid patients in Arizona, provides transportation, as you were mentioning. And I wonder how much of that is actually now part of a future growth opportunity for Lyft that maybe a few years ago we hadn't quite thought that could be included when we're thinking about where this company could go in the future.
I think the healthcare transportation service opportunity is tremendous. And I like the fact that Lyft is focusing on that and not really focusing on food delivery. I don't really think food delivery has a large margin or a huge opportunity. It's great for the customer to be able to get things delivered on demand, but not for the service provider. I think that the opportunity in the healthcare service transportation is huge. Also, Lyft has a number of other key initiatives. They are the official rideshare provider for Disney in both California and Florida. They also have now a partnership with Hilton, where you can earn Hilton rewards points for your Lyft rides, as well as with Delta. You can earn Delta miles from Lyft. I think those are just great marketing opportunities.
Well, Ivan, when you bring up that they are doing a good job of staying away from food delivery, I have to say that sounds sort of a lot like Uber, for example, which we know part of its valuation and the high valuation of Uber was its diversification. It had international growth. It had food delivery. So I guess I'm asking, does it make sense for Lyft to stay in a targeted, sort of simplified one-track strategy versus trying to go Uber's route of being a big sort of having a lot of diversification when it comes to their revenue?
Well, I don't think there's a lot of opportunity. I think there's potential opportunity to deliver food, but I don't think it's a very profitable opportunity. And I think medical service or healthcare service is a profitable opportunity. Partnering with airlines to be the preferred provider is a huge opportunity. With hotels is a huge opportunity because more people are renting cars less when they travel and relying on services like Lyft to get around when they go to when they're on a trip, either for business or vacation.
Wonderful. Tigris Financial Partners Chief Investment Officer Ivan Feinseth, thank you for joining me. And that does it for this edition of Bloomberg Technology. And tomorrow, do not miss our exclusive interview with Apple co-founder Steve Wozniak, talking about the impact of trade war on tech companies and why he's, quote, disgusted with Facebook. And we are live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.